There was a lot of very hardcore Bitcoiners that fear that other token ecosystems could attract capital. And to therefore fight it, this Bitcoin toxicity and stuff has come into the story. And what that did was the reverse. It always happens. Most people who have a fear make it happen by mistake. And so what happened is a lot of people went, you know what? I don't need all of that. So Ethereum kind of makes sense to me. So I think there's been a bit of that. And Ethereum's growing at twice the speed because of that. But I think that will settle down. I think it'll settle down once the price starts going back up again and Bitcoin establishes its trend. I think that level of fear within the community, we talked about fear before, it's the same fear. It's the fear of change, fear of other things. I think that will die down and everyone will kind of settle within the framework. So, overall, nothing's changed.
Let's talk about Ethereum. So this week we had EIP 1559 and this sort of new fee burn structure, right? Transactions are now organized differently, that the base fee is burned as part of every transaction. And there's actually a lot of pieces of this. So if you just look at going back to narratives, the narrative that people have been excited about was ETH becoming deflationary, the base level asset becoming deflationary because more ETH gets burned than is issued. For people who are actually in it, it's actually not, that wasn't the intention of the proposal. The proposal was about making transaction fees smoother, changes in transaction fees smoother, making it easier to use Ethereum. But it's very clear that the narrative capture, the thing that has excited a lot of people is this idea of how it changes ETH as a base asset, as a store value asset. Do you kind of buy that narrative? And that doesn't mean you have to go fully believe it's ultrasound money now, or it's the way that they've kind of canonized it. But how much do you think that sort of deflationary element built into the ETH transaction structure changes or would change the way that, say, an institutional investor would look at it?
Well, I just wrote a whole piece on this in Global Macro Investor, and the title gives it away, The World's Greatest Trade. And I published that last week, and I just said, listen, look at what's going on here. So ETH right now has the fastest adoption rate at scale of any of the protocols. There's huge demand. NFTs are the next wave. There's so much going on in the space. And against that, you've got the move of the coins off exchange for staking, which is a huge number and growing every day. You've then got a bunch of people holding it, so they put it off exchange and in wallets. So you went into yesterday with only 13% of the free float of Ethereum available. And it's got exponential demand. And then you reduce the supply by burning, by whatever margin. Actually, it ended up being roughly what I thought it would be, which was more than most people thought. It's actually quite a big deal. And the next phase after this is that the price is going to be rising just because we're in that point in the market and the demand is big. And so everybody is going to be incentivized to stake. And you can see it in the number of coins in exchanges at 13%. This is going to fall to below 10. There's no free float. And the demand is going up exponentially. We're going to see an exponential price rise. That is the only outcome of this. Now, when we get to the ETH 2.0, let's say it's March next year, and everybody unlocks, there could be a complete collapse. By the rhythm, sell the fact as everybody unlocks. But I think I've never seen a setup like that. I think this setup in ETH is better than Bitcoin was in March 2020.
So that's an interesting comparison point, because that's what I was just going to say. It's like you almost hop, skipped, and jumped right over the narrative side of that and just pointed to market structure, right? And supply and demand and, simple forces, which, by the way, is exactly what we were saying about Bitcoin around the halving, which was a highly rejected by traditional, by TradFi people. We were saying, look, this it is just literally supply and demand, even if you don't buy the narrative. Enough people do that. There's this thing. So it's interesting to hear you kind of almost give the same setup in this case.
Yeah, look, I mean, people call it the triple halving, and I get it, and it makes sense. You rarely get a setup like this because the other part is the macro setup. The macro setup is, I think, global growth comes out weaker for the next 9 months. And I think the Federal Reserve, even if they talk about tapering, will end up accelerating QE. That's how I think this plays out. That's what the bond market is telling you. Once crypto markets sniff this out, they're going to explode. So what we've got is a macro that's potentially there. Macro stories develop slowly, right? They're not quick narratives. It's month by month data. So we will see this over the next 3 months, that we will probably have a global slowdown. We'll probably have the Bank of Japan having to print for the reasons we just talked about, that Japan has totally screwed up the virus. They will do it in size. Chinese economy is in the toilet right now. They will probably do something. So we've got stimulus coming from Asia. Do the Fed do more? Do the Europeans do more? Well, generally they have. Generally, they've generally cut rates twice after every recession. So they're likely to do it again for a number of technical reasons. So we have rate cuts and this perfect setup with no supply and demand in the middle of an exponential bull market. I mean, you don't get these often in your life.
One of the things that you had mentioned when we were first starting to talk about the regulation side is this the catch up that they're playing, and that you weren't worried about is this a security or not type of thing. I, by the way, share that. When I read Gensler's speech, I was like, listen, if our regulatory conversation in the US is the SEC reasserting its authority to determine what is and isn't a security, and that it's ultimately about investor protections, that is a conversation that's so easy relative to the systemic risk. This is a threat to the system kind of challenge, right? They are fundamentally different conversations that may come from some of the similar type looking people. But one of the things that you mentioned potentially on the other side of that is DeFi. And, we don't have that much information yet around just how sophisticated the understanding of Yellen or the Treasury Secretary's, the Treasury Department's understanding of these things are. But it seems like it's very clear that stablecoins are a lot scarier to them than Bitcoin, for example. And it's all of a sudden, DeFi is a phrase that is coming up in every speech, right? What's your take on the regulatory risk around DeFi right now?
So again, if we go back to what we talked about before, they fear change. And this is something where they lose control. Because the cozy world in the past was the Federal Reserve, the banks, and the Treasury were all this nice little group that talked to each other and set interest rates. So there was an old friend of mine, a friend of my father's, and he was one of the old English discount brokers. A discount broker in England was the guys who set the money market rates. But he was of the very old school. So when I knew him, he was still in his 80s. He was in his early 80s, and he would go on the train to London in his silk top hat, black top hat, his waistcoat, and he would go to the Bank of England on a Friday and set the discount rate. And then they would have a long lunch and drink port and then come home after a 4-hour lunch. And that was how the money markets operated.
No wonder people fear change. That sounds awesome. We should totally go back.
I know. But that's how and then the banks would then use that discount rate. So, and so that's the world that these guys know. And suddenly we've got rates that don't mirror the money market rates. What the fuck? Where's this rate coming from? Now, we all know there's relative degrees of risk. Some are staking, which is lower risk. Staking ETH is not a particularly high risk thing, but using a particular DeFi protocol of which we don't know, is there a rug pull mechanism within it by mistake or purposeful? We don't know. But they don't like the fact that the market is setting its own rates and the borrowing and lending function does not come under their control. That's a loss of the control of money. This is why stablecoins matter so much to them, because they need that digital rail. So then if they can control the digital flow of money, they can probably accept stuff like DeFi as an applications layer. But if they don't own the flow of money and they don't own the applications layer, what do they own? They own something in the past, a legacy. This is freaking everybody out. And, DeFi, they understand that it is disruptive, but they kind of would wish that DeFi was done by JP Morgan. And it doesn't work that way.